Hello, wonderful people. Welcome back to the Wilson versus NASDAQ episode 2. And this week, the market basically said AI is still alive, but your easy money phase is dead. So what happened this week? The market started very strong. On Monday and Tuesday, stocks bounced hard. At first, everyone was worried about the month end and quarter end rebalancing. The story was large pension funds have to sell stocks and buy bonds, maybe around $30 billion of selling pressure. Very scary. And then the market realized something important. Most of the selling has already happened earlier. By the time everyone was waiting for the bigger pension sell-off, the actual selling was almost done. So what happened? Short sellers got trapped, dip buyers came in, and the market did what NASDAQ loved to do. It punished everyone who was too late to the obvious trade. The S&P quickly recovered its downside gap, NASDAQ bounced, Semiconductor bounced, and suddenly, July seasonality looked like it arrived early. Historically, early July is usually strong for the US stocks. New quarter, new fund flows, new positioning, and everyone wants the market to look good before the holiday. Basically, Wall Street also knows how to dress up for the family dinner, so by Tuesday, the vibe was the June correction is over, the AI trade is back. Everything's fine, and whenever the market says everything's fine, you should immediately check what is not fine. Because on Wednesday, the whole AI story started to change. The first big headline was Meta. Meta reportedly planned to sell extra AI computing power to outside customers. At first, this sounds good for Meta. It means, hey, we spend millions on the AI infrastructure, and maybe we can finally make some money from it. Investor liked that, Meta went up, but for the rest of the AI infrastructure trade, this was awkward, because the market suddenly asked, wait, if Meta has extra AI compute to sell, does that mean that AI compute is not as scarce as we thought? For the past year, the AI story was simple. There's not enough GPUs, there's not enough memory, there's not enough data centers, there's not enough powers, there's not enough anything. So buy anything, right? But now, Meta is basically saying, actually, we have some extra compute. Do you want some? That changed the mood. It's like going to a sold-out concert, and then the organizer says, by the way, we still have 40,000 extra tickets. Suddenly, the ticket price looked different. That's why the AI compute rental company sold off. That's why cloud infrastructure names got hit. That's why semiconductor started to lose momentum. The market went from AI compute storage to wait till there be AI compute oversupply, and that is a very difficult thing to solve because it's a different valuation theory. And also, the Michael Burry came out. Of course, he did, right? He disclosed the new short positions against the Caterpillar, NVIDIA, Applied Materials, Tesla, and the Semiconductor ETF. His argument was simple. AI infrastructure stocks are too expensive. Some names are too far above their long-term moving averages. And the market is starting to look like a bubble. Now, to be fair, Burry has been bearish many times, and the market has ignored him many times, but his timing matters because this time he arrived exactly when AI hardware was already losing momentum. So even if you don't agree with him, his short position gave the market one more reason to sell first and ask question later. Then come Thursday, and the Thursday was basically AI hardware pain day. On the surface, the market did not look that terrible. The Dow was up, the S&P 500 was almost flat, NASDAQ was down but not destroyed. But under the surface, AI hardware was getting punched in the face. Memory stocks dropped, semiconductor dropped, and the Philadelphia Semiconductor Index fell sharply. And the reason was not just one headline. It was a combination of things. Meta selling compute, SoftBank planning AI cloud services, Apple looking for alternative memory support, and OpenAI reportedly discussing the government support. NVIDIA being questioned for financially supporting smaller cloud players. All of these headlines point to one question. Is the AI supply chain still in pure shortage mode? Or is the market starting to price in competition, oversupply, and margin pressure? That is the real story. Last week, the market asked who makes money from AI. This week, the market asked what if too many people are trying to make money from the same AI trade? And that is why the trade got repriced. Now, not because AI is dead, AI is not dead, but the market no longer wants to pay any price for any company with AI in the sentence. That phase is over. We are moving from the AI excitement to AI due diligence. They're boring. But the market picture is actually not that bad. Pension selling pressure is almost behind us. July seasonality is still supportive. Oil prices are lower. Gold and crypto are weak. which tells you money is still looking for better risk-adjusted places to go, and the labor market is cooling, which could reduce pressure on the Fed to stay hawkish. So from a macro perspective, the market can still go higher in early July, but the leadership is changing. This is no longer a market where every AI hardware stock goes up together. New money, now money is rotating. One day semiconductor lead, next day software bounces, then old tech company came back, then AI hardware sell-off. This is what happened when liquidity is not strong enough to lift everything. And the market become picky, very picky. So what am I watching next week? First, the S&P 500 and the NASDAQ needs to hold their reclaimed levels. If the indices can stay above the recovered gap and the short-term moving averages, the July rally can continue. If they fall sharply, if they fail quickly, then the week's bounce was more like a positioning squeeze than a real breakout. Second, I'm watching the AI capex guidance. This is the most important thing. As long as the Microsoft, Google, Amazon, Meta, and Oracle keep spending on AI infrastructure, the AI supply chain still has support. But if any major cloud company says we are slowing the AI spending, then the market will take it very seriously. Third, I am watching the semiconductors, not because I think that the trade is dead, but because it is crowded. When the trade is crowded, the fundamentals can be right and the stock can still go down. That is the most annoying sentence in investing, right? Fourth, I'm watching whether software can finally take the leadership. If the AI hardware is getting repriced, money may rotate into software, cloud, and old tech names that were previously ignored. That does not mean they're perfect. It just means the market may want a new place to hide. So my final view is early July still has a bullish bias, but the AI trade is becoming more selective. This is not buy AI and relax anymore. This is choose carefully, manage risk, and don't marry your favorite stock because NASDAQ does not care about your feelings. It only cares about liquidity, earnings, and whether someone bigger than you is selling. So yeah, that's it for this week's Wilson versus NASDAQ. If you enjoyed this recap, like and subscribe, and comment down below what sector or stock you want me to cover next. Again, this is not financial advice, this is just financial survival. I'll see you guys in the next video. Bye.